Hello everyone, this is the second part of Showtime Sports Therapy. We've already gone through and we've booked all of their journal entries listed here. What we need to do now is we need to go through and from these journal entries prepare the T accounts for the company in order to make their trial balance, in order to make their financial statements. So let's start by making the T accounts. And I'm going to start with the first one being cash over here. What entries did we have during the month that affected cash? Well, on January 1st, Showtime Sports Therapy had a $100,000 cash contribution from the owner, and we debited cash. Let's take that debit and we'll move it into the T account. So we're going to go and we're going to bring over that $100,000 into our T. The next account that affected, no, I don't like that. Hello everyone, this is the second part of the Showtime Sports Therapy review exercise. We've already gone through and booked all of the company's transactions for the period into journal entries, which are listed here. What we're going to do now is take those journal entries and figure out what the balance of each account is by making T accounts. And after we've gone and find the balance of all of our T accounts, we're going to prepare a trial balance to make sure our debits equal our credits, and when they do, we're going to prepare our three main financial statements: the income statement, the statement of owner's equity, and the balance sheet. Let's start with the T accounts. So in our T accounts, we have one account for every account that was affected in one way or the other during the period. What we need to do is simply transfer the numbers from our journal entries over to those T accounts. So on January 1st, we had a debit to equipment for $150,000. We had a debit to cash for $100,000. We had a credit to owner's capital for $250,000. Well, let's move those debits and those credits over to our T's. So the first thing we had was equipment getting debited for $150,000 on January 1st. So I'm going to go and I'm going to take that number from our journal and copy it right over to the T's. Debit is the left side, so we're putting it on the left side of our T account for $150,000. The next part of that entry was a debit to cash for $100,000, so we're going to go and we're going to bring that $100,000 into our cash T account, and it's there now. And then the last part of this journal entry was a credit to owner's capital for $250,000. Well, let's bring that $250,000 credit over to our owner's capital account. And we've moved all the numbers from our first journal entry into our T's, so let's do it for our second journal entry. In our second journal entry, we had a debit to prepaid rent for $4,800, credit to cash for $4,800. Let's move that debit and that credit over to our T account. So prepaid rent is getting debited for $4,800. We're going to go and we are going to bring that debit over to our T account. So now we got a debit for $4,800 to prepaid rent. The other part of that journal entry was a credit to cash for $4,800, so let's go and we're going to bring that $4,800 credit over to our T accounts. The next journal entry we had was a debit to cash for $500 and a credit to service revenue for $500. Let's bring those numbers over. We have a debit to cash on 1/8 for $500. Brought over to our T account, and we had a credit to service revenue on 1/8 for the same $500. And the next journal entry that we have, I'll make this a little bit bigger. The next journal entry that we have, we debited accounts receivable for $1,500 and we credited service revenue for that same amount. Let's bring those over to our T accounts. Put the accounts receivable debit from the journal entry onto the debit side of our ART account, $1,500. And we're going to take our $1,500 credit to service revenue in that same entry, bring that over to our service revenue T account. So we have a $1,500 credit there. In the next journal entry, we debited cash for $1,000 and we credited accounts receivable for $1,000. Let's do that to our T's as well. Let's put that $1,000 debit to cash into our T account. And let's put that $1,000 credit, which is the right hand side, to accounts receivable into our T account. Next up, we purchased $10,000 worth of tables and chairs for the waiting room, and in this entry we debited furniture for $10,000, we credited cash for $10,000. Let's bring those that debit and that credit over to our T's. So we have a $10,000 debit to furniture. We're going to bring that number from the journal over to the T's. Right there. Then we have a credit to cash for that same amount. Let's bring that number on over. We had a compound entry for our next one, where we had a debit to utilities expense for $300, a debit to salaries expense for $900, and a credit to cash for $1,200. We're going to bring those numbers over. So utilities expense on the 29th got debited for $300. Salaries expense got debited for $900 in that journal entry. So we're going to go grab that number, bring that on over. And then lastly, we had a credit to cash for $1,200 in the journal entry. So we're going to take that number, we're going to bring that over to our T account. And then in the next entry that we had on the 30th, we purchased $1,800 worth of office supplies on account. We debited supplies for $1,800, we credited accounts payable for $1,800. Let's bring those over to the T. So we have a debit to supplies on the 30th for $1,800. We had a credit to accounts payable on the 30th for that same $1,800. And in our last journal entry, we had a debit to withdrawals for $400. We had a credit to cash for $400. Let's take the debit to withdrawals for $400, bring that over to our owner's withdrawals T account. Now it's $400, and we're going to credit cash for that same amount. That's going to be $400. And with that, we have every journal entry in our T accounts. Well, now what we need to do is we need to find the balance of those T accounts, and how you find it depends on what type of account it is. I'm going to start with cash, accounts receivable, prepaid rent, supplies, equipment, and furniture, because they're all asset accounts, and all assets work the same way. They go up on the debit side, they go down on the credit side. So to find our balance, what we're going to do is we're going to add all of the debits together and subtract out all of the credits. So when I do that, I come up with $85,100, which is the current balance of Showtime Sports Therapy's cash. For accounts receivable, add the debits, subtract the credits because it's an asset. So if we take $1,500 and subtract out this $1,000, come up with a $500 balance. Prepaid rent, supplies, equipment, and furniture only have one entry a piece into them. Well, if that's the case, you can just bring down the balance. So our balance of prepaid rent is $4,800. Our balance of supplies is $1,800. Our balance of equipment is $150,000, and our balance of furniture is $10,000. Accounts payable is our only liability, and liabilities go up on the credit side, down on the debit side. So we would add our credits and subtract our debits. But in this case, since we only have one, we can just bring down the balance, making sure it still stays on the same side of the T. Same is true with owner's capital. Owner's capital goes up on the credit side, down on the debit side. You would add all your credits, subtract your debits, but since we only have one, we make sure that we put it on the right side, and we bring down our balance of $250,000. Withdrawal accounts go up on the debit side, down on the credit side. So you would add your debits, subtract your credits. We only have one thing, so let's bring down that $400. Revenue accounts go up on the credit side, down on the debit side. So we would add all our credits, subtract all our debits. We have two of them. So if we did $500 in revenue on the 8th and $1,500 in revenue on the 9th, we add those two together and we come up with $2,000. For utilities expense, we only have one, and that was for $300. Utilities expense, like all expense accounts, goes up with a debit, down with a credit. Add your debits, subtract your credits. We only have one thing. Let's bring down that $300, and let's bring down our salaries expense to get to $900. And with that, we have the balance of all of our accounts. Our company has $85,100 in cash. People owe us $500. We still have $4,800 worth of advance payment for rent on the books. We have $1,800 worth of supplies. We have $150,000 of equipment and $10,000 of furniture. We owe other people $1,800 for things that happen during the normal course of business. Our owner's stake in the business at this time is $250,000. He withdrew $400 during the period. Our business did $2,000 worth of service revenue, and we had to pay $300 in total for utilities and $900 in total for salaries. Well, we got to do one thing before we can make our financial statements. We have to make sure that our debits equal our credits, because in accounting, debits always equal credits, and we're going to do that with this trial balance. And all we're going to do here is, if an account has a debit balance on the T account on the left side, we're going to put it in the debit column or left side of our trial balance, and we're just bringing our balance over. So cash was the first account we had. Cash, according to our T's, has a debit balance of $85,100. Well, let's go and bring that number over to our trial balance. Accounts receivable had a debit balance in our T accounts of $500. Let's put this in. Prepaid rent has a balance of $4,800 on the debit side. Let's put it in the debit column of our trial balance. Supplies has a balance of $1,800. Let's put that number in. Equipment had a balance of $150,000. We're going to bring that number over too. Furniture had a debit balance of $10,000. So we brought all of those numbers into our trial balance so far for our 6 assets that we had. Our next account is accounts payable. And if we go and we look and we see accounts payable has a balance on the right hand side, the credit side. So when we put it in the trial balance, we have to make sure that we're putting it in the correct column. It is a credit, so we're going to bring that over. That's going to be $1,800. Owner's capital has a balance of $250,000 on the credit side. We're going to bring that over. Our owner's withdrawal account, according to our T's, has a debit balance of $400. So let's put that on the debit side. Service revenue, according to our T's, had a credit balance of $2,000. So we're going to put that on the credit side of our journal entry, or of our trial balance. And then both utilities expense and salaries expense have debit balances according to our T's. So we're going to bring those numbers over. $300 for utilities and $900 for salaries. And now that we have all of our accounts in our trial balance, what we got to know is, do our debits equal our credits? So we would add up all of our debits. We would take $85,100 plus $500 plus $4,800 plus $1,800 plus $150,000 plus $10,000 plus $400 plus $300 plus $900. And when we do so, it comes out to be $253,800. That's our total balance of all of our debits. And we know that debits equal credits, so we better hope that we come up with the same number for credits. Well, if we add together this $1,800, this $250,000 for owner's capital, and this $2,000 for service revenue, come up with $253,800. And that's good. At this point, your debits have to equal your credits. If they don't, something's wrong, and you have to go back and you have to fix it. But when they do, you know you have what they call debit credit equality, and you are ready to start preparing your financial statements that you are going to show to people that want to know something about the financial situation of your business. We always have to make them in the same order. So the first one we're going to start with is our income statement. And our income statement basically tells people that want to use our information what was the amount of income your company had during the period. And to find this, the income formula is always the same. It is revenues minus expenses equals net income. So the first thing we want to do is we want to put our revenues up in here. We have 2 columns here, B and C in this case. We're going to want to put our revenues into the right hand column. So for service revenue, we're going to go, and from our trial balance, we are going to take that number. Our service revenue was $2,000. We only had 2 expenses. We had utilities expense and salaries expense. Well, when you have multiple accounts that go under one of these, headers, you put them all individually in the left-hand column and then put the total in the right-hand column. So in this left-hand column, I'm going to go find the balance that we had for utilities expense on our trial balance, which was $300. I'm going to find the balance of salaries expense, which we have here, which is $900. And when we total this all up, $300 for utilities expense plus $900 for salaries expense means that we spent $1,200 in total on expenses. Well, revenues minus expenses equals income. So what was our income? It was the $2,000 we had in revenue minus the $1,200 that we had in expenses. Showtime Sports Therapy made a profit, if you will, of $800 during the month of January. And now that we have that number, we can go and we can figure out what happened to the value of our business during the period. How did this all change? Well, what we're going to do is we are going to start with the amount of capital that we had in the beginning. And the amount of capital that we had in the beginning, for this one, we're going to assume is zero. Why? Because Showtime Sports Therapy is a brand new business. And when you're brand new, you start with nothing. If we had been in operations for a long time, we would have a balance of capital. We'd have to carry over whatever we had at the end of the next period. But for now, since we're brand new, zero is going to be our beginning capital amount. To that, we're going to add two things. The amount of money that our business made internally from operations, how profitable we were during the period. Well, we just found that. That is what the answer to the income statement is. So we add $800 in net income to increase the worth of our business, because if our business made more money, brought in more money than it spent, we're holding on to it, and it has to be increasing the value of the business. The other thing that we're going to add to this is the amount of money which was contributed by the owners of our company. So in our very first journal entry here, we can scroll back up, our owner contributed $250,000 worth of stuff to the business, $150,000 in equipment and $100,000 in cash. So on our income statement, on our statement of owner's equity, the owner's contribution was a nice tidy $250,000. And now what we're going to do is we're going to add these three numbers together to find our subtotal, and that's going to be $250,800. If no money was removed from the business during the period, that would have been the worth of our business. But we did have money come out. Our owner withdrew funds, and if we go on to our trial balance over here, we see that he withdrew $400 during the period. So what we're going to do here is we're going to subtract out that $400. In an accounting lingo, when you are subtracting something like this $400, you put it in parentheses. So we could have been worth $250,800, but our owner took $400 out of the business, which means the actual value of the business at the end of the period is $250,400. And now that we know what our ending balance of capital is, we can go through and do the last of our financial statements, which is the balance sheet. And for this balance sheet, we're going to list our assets, our liabilities, and our equity accounts. And for our assets, I'm going to divide it into two different classes. And what they are is current assets and long-term assets. And what separates something from being current versus being long-term? 1 year. Is it something you expect to use during the next year, expend or convert to cash? If it is, it's a current asset. If it's something you expect your business to have and put into operation for a period of more than a year, it's a long-term asset. And we're going to put ours in a classification called plant, property, and equipment, because our equipment and our furniture, it's not like, they're going to be useless to us after a year. Those are things we're going to have for a very long time. So what we want to do now is we want to go grab the balance of all of our asset accounts. For cash, we're going to go right to the trial balance, and we're going to find the number that we had. It was $85,100. For accounts receivable, our balance according to our trial balance was $500. For prepaid rent, it was $4,800. And for supplies, it was $1,800. So if we add these four numbers together, we get the total amount of current assets we have, which is, again, is the amount of assets that the business has that we expect to expend or convert to cash within the next year. We have $92,200 worth of current assets. Next up, we have our PP&E, our property, plant, equipment. We have equipment. What was the balance of that account? Well, if we go back to our trial balance, we see we have $150,000 worth of equipment And again, on our trial balance, we had $10,000 worth of furniture. So in total, our company owns, by adding these two numbers together, $160,000 worth of assets that we expect to use for a period of more than 1 year. And if we add the amount of current assets we have to the amount of plant, property, and equipment we have in total $252,200 worth of assets. Let's move over to the other side and find our liabilities and our equity accounts. So for liabilities, on our trial balance, we only have one. We have that accounts payable right there, and its balance was $1,800. So on our balance sheet, I'm going to go and I'm going to bring that number on over here. And since that's our only liability, our total liabilities are just at $1,800. For our capital account, the number that we are going to use is not the number that you see on the trial balance, not this $250,000. Why? Because it's not updated. It's not the correct information. On our last financial statement, we just went through and found the change in capital to give us what we ended up with at the end of the period. So instead of taking what's off the trial balance, we're going to take that number, $250,400, and the rest of the numbers on a balance sheet will come from your trial balance. Only this end balance of owner's capital is going to come from the end of your statement of owner's equity. The accounting equation states that your assets must equal your liabilities plus equity at any time. Well, what is our liability plus equity? It's $1,800 in liabilities plus $250,400 in equity. It's $252,200, the same number that we got over here for assets. So our balance sheet balanced, which is good, because if it doesn't, something is off with your numbers. Those numbers should always be the same at the end of every period.